Welcome to the Covered Call podcast, where our goal is to engage in the best and brightest minds of Wall Street. I'm your host, Kevin Simpson, and I'm thrilled to be joined today by my very good friend, Jenny Harrington. Jenny is the CEO of Gilman Hill Asset Management. She is a CNBC contributor. You see her there all the time. And now she is the proud author of the new book, Dividend Investing. Jenny, thank you so much for coming on the show today.
Thank you so much for having me.
All right, I want to jump right into it. I know writing a book isn't easy, and we all know that we have different reasons for doing it, but I'd love to hear about your process. Tell me what you went through and how this got started, and give us the soup to nuts dividend investing. Tell us about it.
So to start writing the book, what I did was I bought all the books I could find off of Amazon on dividend investing. And then I went online. Actually, I had my analysts go online and download everything we could find online about dividend investing also. So there were white papers by Hamlin and by Wisdom Tree, and they were great, really great. But what I found was there was either too much superficiality in a lot of the books out there, or way too wonky academic depth that, you and I love. Like, we love seeing the return of different, dividends by quintile toyed out over, I can't speak anymore, can I? Toyed out over 50 years and see what those different quintiles look like. But our clients don't. And I think you and I have the same clients. And our clients are very sophisticated, wealthy, intelligent people who don't really want to read about different quintiles over 60 years. What they want to read about is kind of the practical and the pragmatic side of dividend income investing or of income investing. And so that's what I tried to write the book towards. I tried to write the book in the middle of neither too superficial nor too academic wonky, but really analogizing and taking real stories of real people and real stories of real investments and saying, here's how this person made their decisions to invest this way. Here's how this investment in national retail properties went right and in advanced auto parts went wrong. So I tried to make a book that was very digestible and attainable and useful for people.
Tell us about what went wrong.
Well, isn't that always the best part? I think one of the things when I was writing this book, I was thinking back to a lot of the investment books that I've read and to when I was at Columbia Business School. And what I realized is you kind of live humbled by all the investment books you read, because you read all these brilliant stories about great investments. But the reality is, Kevin, we don't learn as much from the great investments as we do from the terrible investments. So one of the main stories in here is advanced auto parts. And then chapter 18, I named Short Tales of Woes and Value Traps, New York Community Bank, Lumen, and Cherokee, where I go through 3 of my worst investments. And one was New York Community Bank, where I missed the red flags of a management that was way out over their skis, of Lumen, where they had a lot of fiber assets, and I really misunderstood the value of the fiber assets. I assigned private market valuations to the fiber assets, and they weren't getting them. And Cherokee, way back, you may remember, Cherokee was a clothing brand, and they were bought by Target, but then Target replaced Cherokee with their own in-house brand, and I missed that change in trend. So I really flesh out mistakes in here, because I think, if I actually want to do something for the people who read this book, I think you learn to make better investments by watching others' mistakes more than just hearing the great stories. There's a famous quote at the beginning of Anna Karenina, and it says something like, all happy families are the same. All unhappy families are different and unique in their own way. And I think that's true. All great investments are the same. You put in place the investment thesis, you expected multiple valuation to expand, you expected earnings to grow, and it happened, and the share price went up. Each bad investment is very unique and different. And my friend Charlie Ellis, who actually wrote the foreword to this, he says something really important. Actually, you know what book it was, Kevin? It was when we were talking before about a great portfolio management book, and it was David Swenson's book on portfolio management. So 100%. I think, yeah, that's what it was. So Charlie Ellis writes the foreword in there. And one of the most profound things that he says is, delete a few disasters and compounding will take care of the rest. And so I think one of the things I'm trying to do in this book is help investors delete a few disasters so that compounding can take care of the rest.
But we all have
Pioneering.
investments that don't go as planned. And the best part of being a professional money manager is that we can remove most of the time the emotions from those things and think about it more as a math equation, which is really, really hard for people to do. I remember in 2011, in the fourth quarter, my team and I were thinking that the stock market was going to be under pressure. There was a lot of reasons over the summer for that. But in the fourth quarter, our market call was right. We were right that the market was going to go down. But we went into GDX and some gold miners thinking that gold would be the hedge to protect us against the downside. And of course, wouldn't you know it, gold went down worse than the S&P 500. So trying to educate people on things that we've done wrong and how we navigate through it. Because if you keep the losses small enough, you can always live to fight another day. And to your point, because we read a lot of the same things and talk to a lot of the same people and engage in a lot of the same circles, it's always talking about the good trades, the winners. And they're awesome to talk about. They're super fun. And I want to hear about some of your longest holdings. But I think for investors that are learning, it's always best to hear about how things can go wrong and how you respond and react to them.
Right. Because that's when you prove yourself. There's actually a chapter in here towards the end, and all the stories are real. They're real clients, they're real things. Obviously, I changed the names, but in the chapter about Dr. Kemp was this wonderful client who I worked with for a long, long time. And he was a cardiologist, and he would call me, no joke, every single day for 6 years. And we would talk. I know. Well, I was the low man on the totem pole back then, so I got the call. But I loved him, and he was a brilliant, brilliant man. And he could have 35 stocks in the portfolio, and all he cared about was the 2 that were down. And I would say, I'm like, look, we're having a great year. You've got 33 stocks that are up. Why are we obsessing over these 2? And after years of this, he said to me, he said at one point, he was so frustrated, and he said, it's so unfair. You can make so many mistakes and you still end up well off, or something like that. And he said, I make, as a cardiologist, I make one mistake and someone dies or I get sued. And I thought, oh, that's so interesting. That was the first time it occurred to me how different our comfort needs to be with making mistakes and with taking risk and learning from those mistakes and being able to rally and recover from them.
Well, it's also appreciating things from a different lens. So you can relate to people. But we tend to want to be right more than we're wrong, but we do have a degree of a little bit of buffer to the downside that I suppose a surgeon doesn't have, which is a good point. Because growing up in the business, my mentor would always teach me, the best portfolio managers are those that can navigate volatility in the down market. And the reality is we're going to have stocks that go down. There's sector rotations. There's things that happen. There's stories where we might miss it with respect to lumen or gold. But for us, it's the broader picture, the grand scale, risk-adjusted returns. And from his perspective, it's micromanaging, and I get it. But from a lot of other clients' perspective, risk management means nothing. It's just all about returns, because otherwise they would complain to you when you have really good years and you're up 30%, thinking like, is inherently too much risk in our portfolio for us to have this kind of great outcome. But I love what we do because it's always about buffering the downside far more than it is outperforming to the upside. And with that, we talked about the stocks that didn't perform as well as maybe you had hoped at the outset. What's some of the longer holdings that you've had? Let's brag a little bit about some winners, because we all like.
So my biggest winner is Enterprise Products, and this couldn't be less interesting. It is a midstream energy company, so they have the big pipelines that transport oil and gas all around the United States. And I've held this actually since my days at Neuberger Berman. CNBC did this cool little thing last year called The Art of the Trade, where they came into my office and profiled me, and they asked the same question, like, tell us your best stock ever. And the reality is Enterprise is my best stock ever. So I calculated the return for that. And I realized that over the 17 years that I've held it just in my Gilman Hill time, the annualized return was 9% and change. And most of that's come from dividend yield over the years. Probably on average, about 7% has come from dividend yield, and about 2% has come from a capital appreciation. But if you can hold a stock that pays and raises the dividend year after year after year through the great financial crisis, through what did we have in between? US debt downgrade, Ebola scare, oil crisis of 15, 16, China growth scare of 18, through the pandemic, through everything. If you can have a stock that continues to pay, and grows consistently over time. And by the way, it was a bit of a roller coaster, but the income was always steadily chugging up. So I think something not exciting, not a hey, I bought NVIDIA and I quadrupled my money in 2 years, can actually create those slow and steady returns that build real wealth and help our clients keep their wits about them.
It's a sleep at night stock. I think it had a good year in 2022 also. It's the power of compounding. I mean, you own a company like that, you reinvest the dividends for 17 years. There's a lot of money there at the end. It's a beautiful story.
I think the power of compounding to me is something that most people don't truly appreciate the value of. And whenever I talk to anyone, friends, family, I say, let's really focus on the miracle of compounding. Before you said it's all a math equation, and it really is just a math equation. But if you can own something where, as you said, sleep at night, and it's got the value of compounding, right? Where you go to the rule of 72. If you can grow at 7% a year, your money doubles every 10 years. If you can grow at 10%, your money doubles every 7 years. If you can do that, you build real wealth. But one of the things you said before too, Kevin, you were talking about risk management. And I think that the income that our strategies produce, to me, that's the ultimate risk management. Because if you're in a March of 2020 and you and I can go out and say to our clients, don't worry, your income's there. You can live. You don't need to sell anything at the bottom. The income that you're expecting is coming to you. That's the ultimate risk management, because what it does is it controls for the biggest risk of all, which is not portfolio beta, or not all these. What it is it's bad. The biggest risk of all is behaving badly in a March of 2020 or behaving badly in a March of 2009. That's the biggest risk of all. So
how about April of 2025?
Yeah. Or behaving badly a week ago, 2 weeks ago. It's true. I mean, it's interesting how small the market movement was relative to the level of fear and anxiety that I'm sure you and I both heard from. But when you and I are able to say, hey, your income's safe, you're still getting your dividends, you're still getting the income that your portfolio is producing for you. That's enormous risk management right there.
It's not the cocktail fodder, like you said. It's not like NVIDIA, which quadruples every 8 minutes, but we have true wealth creation. And you look at the history of Gilman Hill for 17 years, and you think about how the assets have grown. I'm sure many of your clients take a distribution. We have a different little bit twist on our business model. We never really see or engage in the end user client, but of the advisors that work with us, I'd say there's probably about half that take a distribution and those that don't. And I always look at the ones that don't. It just amazes me what happens over time. And we talk about stats all the time of dividends, distributions, reinvested, how powerful that is in market performance longer term. But nobody lives it the way we do. And I think that your clients are so lucky to be governed by that calm, steady hand, knowing that for occasionally, and I apologize to the surgeons out there, but occasionally we're going to have stocks that go down. It's the nature of our business. Fortunately, no one dies, hopefully. But if we can be right most of the time, and if we can manage risk and avoid those big drawdowns, I think it's more times than not, the upside will take care of itself. So it's a great way to invest. It's the only way I invest in terms of any real capital, and thinking about dividends moving forward. What's your thought as we move into the rest of this year and into 2026? It was super easy for growth investors when interest rates were at zero forever, because money was free and cheap and everything would go up. But now that you have a little bit of a different world, it seems like people are looking at our portfolios with a little bit more intense interest. That, hey, when there's interest rates out there, when there's no sure thing on the tech trade, when there's some volatility, maybe people are even concerned a little bit about tariffs. I don't know. But how does that set up dividend investments moving forward for the rest of the year?
Well, it's really interesting, because you can look at dividend investing from one of two ways. On the one hand, if you need income, it's always a good time for dividend investing, right? It doesn't matter, if we're in a growth environment and the market's up 25% in back-to-back years. If you need income, it's always a good time. On the other hand, if you are looking for capital appreciation relative to other indices, this might actually be a good time. And when I was saying before, the wonky kind of white paper stuff that we read that'll take the S&P and divide it into 5 quintiles of dividend returns, it's interesting, because what you saw was from 1957 until about 2015, higher yielding stocks outperformed. But I think you could look we did a study, actually. Sorry, I'm getting a little off track, but stick with me because it'll come back in a second.
I should probably, I'm there, I'm with you.
Okay. But you could also say that anything prior to 2015, whether you were looking at value stocks, mid-cap stocks, international stocks, everything kind of up until 2015 performed in a pretty tight band with each other. They all had returns of about, I think it was about, I measured this recently, about 11.5 to 12% on average. But what happened from 2015 until 2025 was we had the top 10 stocks, the Magnificent Seven, whatever you want to call them, the Amazon, Google, Apple, Microsoft, those guys. They sucked up all the air in the room and they distorted all of the relative returns. So now if you look at 1957 or 1960 until 2025, it would say, hey, the only thing you ever really wanted to own was large cap growth. I would say large cap growth over the past 10 years has distorted historical averages. There's a great chart by Ed Yardeni that shows the top 5 stocks in the market over time. And what you see is that leadership changes. So where the top 5 or top 10 stocks have been the same, have been mostly the same for us for the past 10 years, and they've gone from about 15 or 20% of the S&P to almost 40% a few months ago, they've distorted historical averages. So if you believe in mean reversion, if you believe that those top 10 stocks will not lead and outperform the way they have for the past 5 and 10 years, then it's a great time to be in other strategies. I would say it's a great time to be in dividend stocks because dividend stocks are highly concentrated in utilities, midstream energy, real estate investment trusts, consumer staples. By the way, they have a disproportionate amount of their revenues that are found that come domestically versus internationally. So maybe with tariffs, you want to be in stocks that have more US focus, both from input costs as well as sources of revenues. Maybe you want to have more US focus. If you believe, you could take this out to value stocks, you could take it to mid cap, you could take it to international, right? If you just think that those top 10 stocks, they don't even need to go down. They need to just not surge and suck up all the air in the room. And if you believe in mean reversion, it is a great time to be in something else. So if you need income, it's always a good time for dividends. If you want outperformance, to your point, Kevin, with tariffs, with possible recession, with the consistency of that dividend income that people need to rely on, I also think of it a little bit this way, which is when you buy a growth stock, 100% of your return is uncertain. You need the stock to go up. And no small part of that is based on market behavior and other people's whims. When you buy a dividend income stock, let's say you buy something with a 5% yield and you expect 3 to 5% on top of that, some huge portion of that return is certain. And it's nice in an uncertain environment like we're in now to have some portion of your return be quite certain.
I think that was really well said. And the concept of domestic companies with much lower beta, I know you didn't say that part, but also incredibly important when we think about valuations coming down. If we were priced to perfection at the end of 2024 and you thought that a 22 multiple on the S&P 500 was justifiable, it sure is, as long as those growth stocks that represent so much are fueling it. But without that, in the absence of it, and we've seen it already, again, it's just back of a napkin mathematics. These multiples come down, valuations come down. Well, dividend stocks are already trading at lower valuations compared to those growth peers. And that's why they've held up so well this year. And that's why your clients who look at headlines or watch the news or perhaps look at their phones think the world's falling apart. They call you and you say, well, we really haven't lost anything this year. And that's the reality and the beauty. Of course, I'm not suggesting from a compliance standpoint where our portfolios are exactly at this moment, but relatively speaking, it's been pretty flat on the year, despite all the volatility and the massive upheaval that we're seeing and the emotional driven ability for people to get worked up. And that's the nice thing about having you steer the ship, is that you keep the emotions out of it and you bring rational logic to the conversation, and your clients are very lucky.
I love that you keep mentioning the math, because to me, that's all this really is. You and I, when we're creating income-based portfolios, it's just math. You and I don't need to come up with some crazy story on why a company that's grown their earnings at 60% a year for the past 3 years should continue to grow at 60% for the next 20 years. That's hard. It's quite easy to say. If people continue to answer their cell phones, then, Verizon, for example, Verizon's earnings will continue to grow at 3%. Verizon makes X billion dollars of free cash flow. They will continue to pay their dividend. The dividend's 7%. You add 2 to 3% to that, you get 10%. If you can get 10%, it doubles in 10 years. That's much easier than creating stories. So yeah, I really think that the magic of what we do is in the ability to tune out the noise and focus on the math.
High single-digit growth expectations. That's all we need.
Achievable.
Yeah. And what I always preach is that if we have companies that are increasing their dividends, that's the magic behind all of it. And as long as they're increasing their dividends because their earnings are increasing, then we always assume that eventually their share prices should trend higher. And that's the just, I think, the secret to the success of what you do. I know we talked about your clients benefiting from all your knowledge, but I'd like to hear about who's benefiting from your book. And I admittedly already know the answer, but I feel like it's a good place to plug the proceeds of dividend investing.
Well, thank you. Well, I got the idea from you. So when you and I were having lunch together, no, it's true. When you and I were having lunch together a couple months ago, we had an impromptu lunch after the show, which was such a treat. We both just had a little time to spare, and we sat down and had a lovely lunch. And I told you about the book, and you said, "Oh, when I wrote my book, I donated my profits to the Council for Economic Education." And I said, "Oh my gosh, that's a brilliant idea. I'm on the board of the Council for Economic
Education." Which I did not know at the time, which
it was so great. And I hadn't thought about it, but what a great thing to do. So all of the profits from dividend investing go to the Council for Economic Education, which is an organization in its 75th year. And their objective is to teach teachers, K through 12, how to teach economics. They also have a program called Investing Girls, which focuses on financial literacy. So it's really teaching economics and financial literacy in K through 12. They also advocate at the state level to have economics and financial literacy be a high school graduating requirement. And this is really important. And it's really actually hard to fundraise for because it pulls at no heartstrings. But economics at its core is really just decision making and understanding why decisions are made and understanding the basics of supply and demand and pricing and why things happen. I believe that if more people understood basic economics and basic financial literacy, far better decisions would be made comprehensively. I think a little bit of financial literacy can wildly change the dynamics of an entire family and generations of that family to come. So I think it's important, and I'm delighted that hopefully a few more people will buy the book just to have their brains, enhanced by reading it and helping CEE.
It's best for both. Now, here in Florida, we do have many of the school districts that have financial literacy as part of that requirement, which is super cool. And even the colleges here locally really promote students. And part of it is actually managing endowment funds with real money, where they have a portion of the endowment that they can manage. So it's amazing. Also helping to educate the college kids here with Bloomberg is another really exciting thing. But I will speak for me, and you can comment on it from your perspective. But growing up, my father was a teacher. My mother didn't work. We didn't have, she worked a lot at home, but we didn't have a financial literacy, strong economic background that was being beaten into me through high school. And it wasn't until I was really introduced to it at my senior year, just as a personal interest, and then in college. And my first day working, which was in some point in 1992, my mentor was a brilliant investment manager, said to me, "Is like, forget everything you think you know, because you don't know anything, and we're going to start from scratch." And sort of inwardly, I'm like, "Hey, you're right. I really don't know that much." Even having gone through it at college, I didn't feel prepared or overly educated in terms of how to really think about broad personal finance, and that's what I think people are so benefiting from through the Council of Economic Education.
That's interesting. I had a different upbringing, which is my dad was an entrepreneur, and we rode a serious roller coaster financially. I have 3 younger brothers, and it didn't impact them the same way that it impacted me. But I went from having a very nice, cushy lifestyle to shopping at the Goodwill from all through high school through college, because there was no money, none. And that was really, really tough on me. So it's interesting because then I kept gravitating towards money management. This is too long a story for the podcast, but I kept gravitating all through my internships towards money management. And then I got to Goldman Sachs, and it was 1997, and it was the dot-com boom. And it was in some ways like today, a lot of really, really high flyers, a lot of needing to construct stories that would argue for companies growing to the moon, and producing 100% revenue and earnings growth for the rest of eternity. And so while I loved the investment side of it, that volatility made me quite sick. So in 2001, I had a client call, and he said, and by the way, at this point I was at Neuberger. He said, look, I'm 55, I'm getting ready to retire. I need income, but I still need growth because I'm too young. What can you do for me? And I created the dividend income strategy for him. And I didn't do it intentionally. I just did it out of necessity for this one guy. But it was interesting because everything about it resonated with me. Most importantly, the idea of completely consistent income, which we hadn't had, and real serial entrepreneurs, they can handle it. Like my dad could handle it without any, anxiety from what I could tell. He could handle those big fluctuations. My brothers can handle those fluctuations. I cannot. It makes me sick to not know where the money is coming from, when it's going to be there, how it's going to be there. So everything about this consistent every month. Dividends are being plunked into your account. Again, it's the great financial crisis. It's March 2020. Guess what? Dividends are being plunked into your account. It's interesting. I don't think I could be any other kind of investor. I personally don't have the emotional risk tolerance to handle being a growth investor. I need to know that if I'm going to be investing, there's a large component of certainty. But getting back to your math, bond math is far inferior to stock math, right? If you buy bonds, the income doesn't grow, and you might not keep up with inflation if you're in an inflationary environment. So everything about the kind of mathematical, able to project part of dividends resonates with me because of that rocky childhood. Financial literacy, I had none. Zero.
You also enjoyed what it was like to have money, and then realized that you needed to get back to that. We didn't know any better, but I saw it on television. I was like, it must be pretty neat to have some money. But the dividend growth is the secret hedge against inflation, whether it goes back to 9% because we're in a pandemic, God forbid, or the Fed gets it down to the 2% target. The bond investor has a static income stream with a depreciating value of the asset. Hopefully, in our case, we have an increasing dividend and an appreciating asset. And that's not to say people shouldn't own bonds. You should have an asset allocation and work, within a risk budgeting environment. But we're speaking from a portfolio management standpoint. Jenny and I run equity portfolios. We're not as objective.
One thing that's interesting, when you read all those wonky white papers that I was referring to before, you see time and again that the average dividend yield of the S&P grows at 5.7% a year, going way, 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 way back. Coincidentally, the portfolio I manage, which has an objective of generating a 5% or better dividend yield with growth on top of that, the growth comes both from dividend growth as well as capital appreciation. Coincidentally, our portfolio also grows its income at about 5.7% a year. And that's not intentional. That's just coincidental. But when you think about the inflation levels that you and I have seen in our lifetime, but for brief pockets, on average, it's been about 2 to 3%. So if we think about dividends growing at 5.7%, your income does well outpace inflation.
It's nice to get a raise every year. And that's just,
yes, it is.
I mean, there's no more sophisticated way to explain it. I mean, that's what we're trying to do. We're trying to walk in the door every year with a defined cash flow, recognizing there's some variable, and expecting that through good corporate governance that those dividends will increase and that we'll be able to keep pace with that inflation for next year. It's a beautiful thing. It's boring somewhat, but it's a true way to tremendous wealth. And I think of no other thing I'd rather do.
Same. It's pragmatic and it's useful. And then you and I aren't out there every year defending ourselves, saying, hey, the S&P returned 25%. I'm so sorry I only returned 20% this year. You and I can say, you saved your whole life. And we've created something useful for you that gets you from here until the end of whatever's at the end. It's nice to manage something that's useful.
Well, you do an amazing job with it. I'm so grateful that you spent some time with us today. I'm halfway through the book. I'll be finishing it this weekend. I hope that everyone will go out and buy Dividend Investing by Jenny Harrington, remembering that all proceeds go to the Council for Economic Education, an amazingly worthy cause. I enjoy all the time that we spend together is great, but I hope everyone was able to kind of share in our friendship today. Thank you for your time.
Thanks so much for having me.
Thanks, Jenny. Oh, but by the way, you told me, it has nothing to do with any of this. You told me to read the book about the whale, the
$1 billion whale.
Yeah, that was amazing.
Right?
Amazing. Totally unrelated to any of this, but I never thank you for that.
Bananas stuff in that.
Unbelievable.